Your money is trapped, and you do not know it yet. Right now, as you are watching this, Wall Street's biggest firms, Blackstone, BlackRock, Morgan Stanley, Blue Owl, have locked the doors on over $150 billion in investor funds. People are calling to withdraw their own money and being told no. $265 billion in market value has been wiped off the books. If your financial advisor put any portion of your retirement into a private credit fund in the last 3 years, there is a real chance you cannot access it today. That is not the scary part. The scary part is that is only number 10 on this list. 722 banks in this country are hiding unrealized losses that exceed half their capital. The Fed just injected $18.5 billion in emergency overnight loans to keep them standing. That happened this week. You did not hear about it because nobody reported it. Bank of America just declared the U.S. has entered stagflation, not warned about it, declared it. The economy lost 92,000 jobs last month. Inflation hit 3.3%. Real wages just went negative, which means your paycheck buys less today than it did 30 days ago, even though the number on it did not change. The CME FedWatch tool now shows a greater than 50% chance the Fed raises rates next. 6 weeks ago, everyone expected cuts. That expectation is dead. Iran is charging yuan tolls on the Strait of Hormuz. The dollar's global reserve share just fell below 57% for the first time since 1995. Central banks bought 1,100 tons of gold last year because they no longer trust the currency you earn. AI wiped out 1.17 million jobs in 2025. The CEO of one of the largest AI companies on Earth said half of all entry-level white-collar jobs will be gone within 5 years. Bankruptcies are up 14%. Foreclosures have climbed for 12 straight months. And Michael Burry, the man who saw 2008 coming before anyone else, just said the next crash will be worse than all of them. There are 10 things about to hit this economy at the exact same time, not one after another, all at once. That is what makes this different from anything we have seen before. And by the time you get to number 1, you are going to understand why this video might be the most important thing you watch all year. Let's get into it. Number 10. Wall Street just locked the doors on $265 billion, and most Americans have no idea their money is trapped inside. All right, I need you to pay very close attention to what I am about to tell you, because this story is happening right now in real time, and almost nobody in the mainstream media is covering it in a way that normal people can understand. There is a $3 trillion shadow banking system in this country called private credit. It is a world of non-bank lenders, funds that were sold to everyday investors as safe, high-yield alternatives to bonds and savings accounts, promising 9 to 12% returns with quarterly access to your money. Retirement advisors put their clients into these funds: firefighters, teachers, small business owners, regular people looking for a better return than a savings account. And right now, as of this week, $265 billion in market value has been wiped out from the companies that manage these funds, and the biggest names on Wall Street are locking the doors so investors cannot get their money back. Fortune magazine reported that Blackstone's $82 billion flagship private credit fund got hit with $6.5 billion in redemption requests in a single quarter, 7.9% of the entire fund. And Blackstone executives had to inject $400 million of their own personal money just to stop a run on the fund. BlackRock restricted withdrawals on its $26 billion HPS corporate lending fund after redemption requests hit 9.3%, nearly double the quarterly cap. Morgan Stanley got repurchase requests for 10.9% of shares in its North Haven private income fund and capped payouts at 5%. Cliffwater, which manages $33 billion in private credit, saw investors try to pull 14% of their stakes, and Blue Owl Capital permanently closed the redemption gates on its $1.6 billion OBDC2 fund after withdrawal requests surged 200%. In Canada, roughly $30 billion invested in private real estate funds, about 40% of the total market, is now completely gated. Your money is in there, and you cannot take it out. CNBC reported this week that private credit defaults have surged to a record 9.2% according to Fitch Ratings. The SEC has launched investigations into valuation practices. Blue Owl shareholders have filed a lawsuit alleging the firm failed to disclose material risks. Jamie Dimon warned back in September about cockroaches in private credit, and now JP Morgan has restricted its own lending to private debt funds. Fortune called it the $265 billion private credit meltdown and described how fund managers who were supposed to hold cash reserves in safe treasuries had instead parked that money in riskier software bonds to chase higher returns, and when those bonds dropped in value, the cash cushion that was supposed to fund redemptions evaporated. One industry analyst told CNBC that the market that promised retail investors liquidity has now been definitively proven to be an illusion. An independent advisor and former CEO of a firm acquired by Apollo said publicly that the industry has lost control of the narrative. And the comparison that keeps coming up from multiple serious analysts is 2008. Not because the scale is the same, but because the mechanics are identical. Illiquid assets were bundled into opaque vehicles and sold to retail investors as safe yield-bearing instruments. When the underlying assets deteriorated, the funds could not honor withdrawal requests. The packaging changed from mortgage-backed securities to private credit BDCs, but the math did not. And right now, over $150 billion in retail capital is trapped behind gates in vehicles that cannot honor their promises. If you have money in a private credit fund through your retirement advisor or your wealth manager, call them today. Ask specifically whether any of your holdings are in semi-liquid private credit vehicles and whether any redemption gates have been activated. Because the window to understand your exposure is closing fast, and by the time the next round of earnings reports comes out in April, the picture could look significantly worse. The word that keeps the Federal Reserve awake at night just became the baseline economic forecast for 2026. There is a word in economics that describes the single worst scenario for your money, your job, and your future all at the same time. That word is stagflation, and as of this week, Bank of America is no longer calling it a risk. They are calling it a description of what is already happening. Bank of America economist Claudio Irigoyen and his team published 3 words that every American needs to understand right now: mild stagflation. Not a prediction, not a warning, a diagnosis. BofA revised its U.S. growth forecast down to 2.3% and its headline inflation forecast up to 3.6%, an upward revision of 80 basis points from the pre-war level of 2.8%. The OECD has revised U.S. inflation forecasts upward to 4.2%. Michigan consumer inflation expectations have climbed to 3.8%, and the CME FedWatch tool now shows greater than 50% probability that the Fed's next move will be a rate hike, not a cut. That is a complete 180-degree reversal from where markets stood 6 weeks ago when everyone expected rate cuts to begin by June. Let me explain why this matters to you personally, because I think a lot of people hear stagflation and their eyes glaze over. In a normal recession, prices fall as demand drops and the Fed cuts rates to stimulate growth. The playbook is well understood and it works. Stagflation breaks that playbook completely. Prices keep rising even as the economy slows, which means the Fed cannot cut rates without making inflation worse, and cannot raise rates without pushing the economy deeper into contraction. There is no clean move. There is no rescue. The Fed is trapped between its 2 mandates: price stability and maximum employment, pulling in opposite directions simultaneously. And the trigger is identical to the 1970s, an oil supply shock from a geopolitical crisis in the Middle East. The 1973 OPEC embargo shut off oil, inflation hit 12%, GDP contracted, and it took Paul Volcker hiking interest rates to 20% in 1980 to finally break the cycle. That cure caused one of the deepest recessions in modern American history. Right now, Brent crude is trading above $110 a barrel. Oil production across Kuwait, Iraq, Saudi Arabia, and the UAE has collectively dropped by at least 10 million barrels per day, which the International Energy Agency called the largest supply disruption in the history of the global oil market. Inflation hit 3.3% in March. Gas prices jumped 21% in a single month. Real wages just turned negative, which means your paycheck is now buying less than it did 30 days ago, even if the number on it did not change. The February jobs report showed the economy lost 92,000 jobs when economists expected a gain of 55,000. Unemployment ticked up to 4.4%. Moody's AI model now puts recession probability at 49%. Goldman Sachs is at 30%. Ed Yardney, one of the most respected Wall Street strategists, said there is a 35% chance of stagflation this year and lowered his melt-up scenario from 20% to 5%, while raising his meltdown scenario from 20% to 35%. Prediction markets have jumped from 20% recession probability to 42% since January. A Kellogg School of Management economist said publicly that today's environment is more like the 1970s than 4 years ago. Vanguard wrote this month that this is a classic stagflationary shock, and that the combination of high inflation and low growth could weigh on both stock and bond prices simultaneously, which means there is no safe place to hide in a traditional portfolio. And here is the detail that connects this directly to your life. The street calculated that if you were trying to buy a $600,000 home, it would cost you $168 per month more today than it would have cost you the day before the war started. Mortgage rates are climbing because the bond market is repricing the expectation that rates stay higher for longer, possibly permanently. If you were planning to buy a home, refinance, or take out any kind of loan this year, the math just changed underneath you. And the people in the White House are telling you this is the last of their concerns. Their own economic advisor Kevin Hassett said publicly that if the war were extended, it would not really disrupt the economy very much at all. Meanwhile, diesel is above $5 a gallon for only the second time in history. Groceries are spiking, airlines are hiking fares 85%, the Fed cannot cut rates, the economy is losing jobs, and the S&P 500 just posted its worst quarterly performance since 2022. That is not a rough patch. That is a structural economic trap that has no easy exit, and the last time America fell into one, it took a decade to get out. 1.17 million people lost their jobs in 2025, and the technology that replaced them is now coming for every white-collar worker in America. January 2026 recorded more job cuts than any January since 2009. Let that sit with you for a second. More people were laid off in 1 month than at any point since the Great Recession. And the difference between 2009 and now is that in 2009, the economy collapsed and companies cut because they were bleeding money. In 2026, many of these companies are posting record profits, and they are still cutting. Challenger, Gray, and Christmas, the firm that has tracked layoffs in America for decades, reported that in 2025 alone, 1.17 million jobs were eliminated across the country, the highest annual total since the pandemic year of 2020. And of those 1.17 million layoffs, nearly 55,000 were directly attributed to artificial intelligence, which is more than 12 times the number of AI-related job cuts from just 2 years earlier. But here is the part that should terrify you. Those 55,000 are just the ones where companies openly said the words artificial intelligence in their layoff announcements. The real number is significantly higher because most companies do not admit they are replacing humans with machines. They use phrases like restructuring, efficiency initiative, strategic realignment, or workforce optimization. CBS News reported this month that companies are increasingly pointing to AI when announcing job cuts, and that Amazon CEO Andy Jassy said publicly he expects the company to shrink its white-collar workforce as it invests in AI agents. Workday cut 8.5% of its entire workforce, about 1,750 jobs, specifically to reallocate resources toward AI. PayPal is cutting 20% of its staff, roughly 4,760 workers. And MIT researchers calculated that today's AI systems could already automate tasks performed by more than 20 million American workers, which is 11.7% of the entire U.S. labor force. Now, here is what makes this different from every previous wave of automation in American history. Previous technological disruptions, the assembly line, the personal computer, the internet, they eliminated specific categories of jobs but created new ones in adjacent fields. A factory worker lost their job, but a computer technician gained one. This time, the technology is going after the jobs that were supposed to be safe. The white-collar jobs, the knowledge workers, the lawyers, the accountants, the coders, the marketers, the radiologists, the customer service managers, the HR departments. Anthropic CEO Dario Amodei warned that AI could eliminate 50% of all entry-level white-collar jobs within 5 years and potentially push unemployment to 10 to 20%. Microsoft AI chief Mustafa Suleyman predicted that most white-collar jobs could be automated within 1 to 5 years. Verizon's CEO predicted AI will cause unemployment to rise by up to 30% within 2 to 5 years. Boston Consulting Group issued a report saying 10 to 15% of existing jobs could be eliminated as soon as 2031. And Goldman Sachs estimates that AI is already reducing U.S. employment by roughly 16,000 jobs per month right now. A Yale study published last week said the real job destruction from AI is hitting before careers can even start. Entry-level positions, the jobs that young people need to get their foot in the door and develop the skills to eventually lead, those jobs are disappearing first. And the software QA manager in the reference footage who said he has been in IT for 30 years and for the first time in his career, he is genuinely nervous. He is not being dramatic. He said he no longer needs to code, no longer needs to analyze tickets, no longer needs to create test cases. He just prompts the AI, and it does all of it from start to finish. That is not a future prediction. That is happening right now in his office today. And when the people at Microsoft are telling you privately in their own meetings that most of their executive team will be without jobs in 3 to 5 years, and those are the smartest people in the world building the technology themselves, you need to understand that the clock is running, and it is running faster than any government or policy framework is prepared to handle. 150,009 Americans filed for bankruptcy in the first 3 months of 2026, and the wave that is coming this summer will make that number look small. Bankruptcy filings in the United States just hit 150,009 in the first quarter of 2026 alone. That is a 14% increase from the same period last year, and every single category is accelerating. Individual Chapter 7 filings, which is the most common form of consumer bankruptcy, where you liquidate your assets because you have nothing left, surged 17% to 89,259 cases. Chapter 13 filings, where people try to restructure their debts over time, rose 8% to 51,962. But the numbers that should truly alarm you are in the business category. Commercial Chapter 11 filings surged 37%. And small business bankruptcies under Subchapter 5 exploded 67% year over year, from 499 to 833 cases. In February 2026 specifically, consumer bankruptcies were up 13% over February 2025, and business bankruptcies were up 21%. And then in April, commercial bankruptcy filings jumped another 42%, with 644 Chapter 11 filings in a single month. Now, here is the thing about bankruptcy data that most people do not understand, and that makes this so much more dangerous than the headline numbers suggest. Consumer bankruptcies are a lagging indicator. They do not spike at the beginning of a crisis. They spike months after the crisis has already begun, because people do not file the moment they lose their job or miss a payment. They try to hold on. They max out credit cards, they drain savings, they borrow from family, they sell things, they skip meals, they fall behind on one bill, then two, then 3, and only when every other option has been exhausted do they file. That is why the analyst at Epic specifically warned that the commercial surge we are seeing right now in early 2026 will translate into elevated individual filings by late summer or fall, because the layoffs happening today take 60 to 90 days to convert into personal bankruptcy filings. The timing of this could not be worse, because the people filing right now are filing into an economy that has no safety net left for them. The NY Fed's January 2026 survey found that 15.3% of Americans expect to miss a minimum debt payment in the next 3 months, the highest reading since April 2020, with the hardest hit being people over 60, without college degrees, and households earning under $50,000. Americans are carrying $18.8 trillion in total household debt. Credit card debt has crossed $1.3 trillion at an average APR of 23%. The delinquency rate on all outstanding balances worsened to 4.8% in late 2025, with notable upticks in credit cards, mortgages, and student loans. And 111 million Americans, about 40% of all U.S. adults, are carrying a revolving credit card balance every month. 27 million of them can only afford to make the minimum payment. And when you can only afford the minimum at 23% interest, your balance is not going down, it is going up. That is the definition of a debt spiral. And now layer on top of all of that the fact that 4 million COVID-era EIDL loans totaling $387 billion are coming due, and the Treasury collection deadline was March 31, 2026. Federal debt collection is different from private debt. The government can garnish your wages, seize your tax refunds, and withhold Social Security benefits without a court order. There is no statute of limitations. They will take what they are owed. So you have a situation where bankruptcy filings are surging, credit card debt is at a record, delinquencies are climbing across every category, 15% of Americans expect to miss a payment in the next 90 days, federal COVID loan collections just kicked in, the Iran war is driving up the cost of every basic necessity, and the job market just posted its first negative print in 2 years. All of those forces are converging on the same households at the same time. And the bankruptcy numbers you are seeing right now in Q1 2026 are the early tremors. The earthquake arrives in Q3. 119,000 properties entered foreclosure in the first quarter alone. And the insurance crisis is about to make millions of homeowners wish they were renting. 12 consecutive months. That is how long foreclosure filings have been climbing in the United States without a single month of relief. Atom's latest data shows that nearly 119,000 U.S. properties recorded a foreclosure filing in the first quarter of 2026, a 26% increase from the same period last year. And that number is accelerating, not stabilizing. But here is the part that nobody is connecting to the broader picture. The foreclosure surge is not being driven by the same thing that caused 2008. Back then, it was toxic subprime mortgages and ninja loans. This time, the people losing their homes are not people who should never have gotten a mortgage in the first place. These are people who did everything right. They put money down. They qualified under strict post-2008 lending standards. They locked in fixed-rate mortgages. And they are still being crushed because of something that has nothing to do with their mortgage payment. Insurance. Homeowners insurance. Premiums have jumped 30 to 60% in states like Florida, Texas, and California. In Cape Coral, Florida, one of the hardest-hit markets, a $350,000 home now costs $7,700 a year just in insurance, which is 2.2% of the property's entire value, every single year, just to keep the insurance current. That is on top of the mortgage, the property taxes, the maintenance, the utilities, and everything else. And property tax reassessments based on inflated pandemic-era home values are slamming homeowners with bills they did not see coming. Remember the woman in the reference footage whose mortgage jumped $670 in a single month because her insurance doubled from $3,000 to $6,000 and nobody told her? That is not an outlier. That is the pattern. Legal Shield reported that legal requests related to foreclosures reached their highest level in 5 years, with calls spiking to the highest level since April 2020. Their senior vice president said people are reaching out to lawyers to save their homes and they are scared of the next shoe to drop. And FHA loan delinquencies, which are the loans that serve lower-income and first-time homebuyers, have surged to 11.52%, which is 6.5 times higher than conventional loan delinquencies and the highest level since Q2 2021. Mortgage payments now consume over 30% of median household income compared to 21% pre-pandemic, and that is the key threshold that historically predicts future defaults. Homeowners with adjustable-rate mortgages are confronting sharp payment increases as their loans reset in a high-rate environment. Older Americans on fixed incomes are being squeezed by property taxes they cannot control. And tariffs are adding $9,200 to $17,500 per new home, according to NAHB estimates, which is further strangling the supply of affordable housing. More than 70% of homeowners and prospective buyers told Legal Shield they worry that a potential recession and tariffs could disrupt their housing plans. Legal Shield's Housing Construction Index has fallen to its lowest level since March 2020, suggesting builders are pulling back on new projects, which means the supply shortage that is already making homes unaffordable is about to get worse. And now layer the Iran war on top of all of this. Mortgage rates had fallen to near 3-year lows before the conflict. They were at 5.98% on February 26th. The war started 2 days later. By March 19th, they had climbed back to 6.22%, and they are still rising. Every quarter-point increase in mortgage rates knocks hundreds of thousands of potential buyers out of the market and adds hundreds of dollars to monthly payments for anyone trying to buy or refinance. The housing market was already fragile before the war. The war just removed the one piece of good news, falling rates, that was keeping the system from cracking. And for the 119,000 families who entered foreclosure this quarter, the crack has already arrived. 5 waves of price increases are heading toward your wallet right now, and most Americans will not see a single one of them until it is too late. Higher gasoline and diesel prices are now costing the American economy an additional $500 million every single day. Not per month, not per quarter, per day. And that is just wave 1. Because what most people do not understand, and what I need you to understand right now, is that the economic impact of the Iran war is not one price spike. It is a rolling series of 5 shocks arriving on different timelines, each one compounding the last, and by the time most people recognize the full picture, 4 of the 5 will have already hit. Wave 1 you already know, gas. It showed up within days. The national average jumped from under $3 to $3.88 as of the latest AAA reading. In California, drivers are paying over $5.30. Diesel, the fuel that powers the 18-wheelers that deliver literally everything you buy, surged 36% to over $5 a gallon, a level that has only been reached one time before in American history. Wave 2 is landing right now. Groceries, specifically the perishables, the produce, meat, dairy, the things that cannot sit in a warehouse waiting for prices to stabilize. Diesel powers the refrigerated trucks that bring those items to your store. CNN reported this week that it now costs $895 to fill a food delivery semi-truck, up 26% from $711 at the end of February. Retailers have been absorbing costs for months, first from tariffs and now from the war. A Boston College economics professor warned that if oil prices stay elevated for any meaningful period, you will see a persistent cost shock that businesses simply cannot eat anymore. And when they stop absorbing, the sticker price catches up fast. Wave 3 will not arrive for months, but it is already baked in. Fertilizer. This is the one that should genuinely scare you because it operates on a delay that makes it almost invisible until the damage is done. 1/3 of global fertilizer passes through the Strait of Hormuz. Urea is up 35%. An Illinois corn farmer told CNN this week he called his fertilizer supplier and could not get a price quoted at all because the market is moving too fast to even name a number. The food you eat in September and October is getting more expensive right now because of inputs that farmers are paying a premium for this month. You will not feel this wave until fall. By then it will be too late to prepare for it. Wave 4 is airfare. Jet fuel has surged roughly 85% since the war began. Airlines from Qantas to SAS to India's biggest carriers have already announced fare hikes. And unlike gas, which fluctuates daily, airlines bake fuel costs into their pricing models months in advance. Those higher fares are not coming down fast, even if oil drops tomorrow. If you are planning any kind of summer travel, your ticket prices are about to hurt in ways you cannot avoid. Wave 5 is the one almost nobody has connected yet. Interest rates. The Federal Reserve was expected to start cutting rates this year. That expectation is dead. Some economists now project the first rate cut will not happen until the third quarter at the earliest. Morgan Stanley issued a note saying markets have effectively taken rate cuts off the table for 2026. The CME FedWatch tool shows greater than 50% probability that the next move is a hike, not a cut. If you were planning to buy a home, refinance a mortgage, or pay down a credit card, the cost of borrowing just went up, and it is staying up longer than anyone expected 6 weeks ago. So let me ask you this. When you first heard that oil prices spiked, how many of these 5 waves did your mind immediately connect? 1. Maybe 2. That is not a criticism, that is human psychology. Behavioral scientists call it anchoring bias. Your brain grabs the most visible data point, the number on the gas station sign, and uses it as a stand-in for the entire economic impact. And because gas prices feel annoying but survivable, your internal threat assessment files the whole crisis under temporary inconvenience. Meanwhile, the IEA called this the greatest global energy security challenge in history, not a moderate disruption, the greatest in history. And your anchoring bias is whispering you will manage. Michael Burry just warned that the next crash will be worse than any of them, and Wall Street's own data says he might be right. The man who predicted the 2008 financial crisis just posted a warning on Substack, saying that the US market is a coiled spring primed for a massive crash. And before you roll your eyes and say people have been predicting crashes for years, let me walk you through his actual argument because it is built on structural math, not opinion, and the data backing it up is coming from inside Wall Street's own house. Michael Burry's first concern is passive investing. Over 60% of all equity fund assets are now in passive index funds. Your S&P 500 ETFs, your target date retirement funds, your 401k allocations. Those funds buy everything in the index regardless of whether the individual companies are actually worth the price. Nobody is doing real price discovery anymore. Burry calls it idiot savant money. It flows in, but no fundamental analysis is happening at the stock level, and here is where it becomes a ticking bomb. Most of that passive money came from baby boomers putting cash into their 401ks for decades. That generation is now hitting the age where they are legally required to start withdrawing. Required minimum distributions. And Burry is saying that by 2028, for the first time ever, those mandatory withdrawals will exceed new contributions flowing in. The engine that pumped the market up for 30 years is about to start running in reverse. Then there is the buyback collapse. Companies like Amazon, Alphabet, Microsoft, Meta, and Oracle had their combined share buybacks drop by 74% in Q4, down to just $12.6 billion. Why? Because they are borrowing tens of billions of dollars to fund AI infrastructure instead. Oracle borrowed $25 billion, Meta borrowed $30 billion. Buybacks have been propping up stock prices for years by reducing the number of shares outstanding and artificially inflating earnings per share. When that support disappears, the prices that were held up by financial engineering instead of actual earnings growth become exposed, and the current market environment is confirming the fragility in real time. The S&P 500 has dropped nearly 7% from its January peak. The Dow posted 4 consecutive losing weeks, its longest streak in 3 years. The Nasdaq briefly dipped into correction territory, down nearly 10% from its high. The Russell 2000, which tracks smaller companies more sensitive to interest rates, officially crossed into correction territory. Brent crude surged to nearly $120 before settling at $112, its highest close since 2022. Gold spiked above $5,400 an ounce, and then crashed more than 10% in a single week, its worst performance since 1983. Even the safe havens are not behaving the way anyone expected. The VIX, Wall Street's fear gauge, surged from the mid-teens to nearly 32. And here is the historical context that makes Burry's warning so hard to dismiss. An RBC Wealth Management analysis across 20 major post-Armosoft World War II military interventions found that the S&P 500 fell an average of 6% during the conflict, but recovered within months. The people who sold in panic locked in their losses. The people who held through captured the recovery. During the March 2020 crash, the market recovered in 57 days. Many who panicked sold at the bottom never got back in. They sat on the sidelines waiting for certainty that never came, while the recovery happened without them. And the math on missing the recovery is brutal. Miss just 10 of the best trading days over a 20-year period, and your returns get cut roughly in half. Miss 20, and you barely beat inflation. The best days and worst days cluster right next to each other on the calendar. You cannot capture the upside if you fled during the downside. Burry's conclusion is that when the crash comes, and he believes it is coming, it will be more violent, more correlated across asset classes, and longer in duration than anything we have seen in modern history. Because the passive investing bubble, the buyback withdrawal, the AI reallocation of capital, the demographic shift of boomers withdrawing instead of contributing, and the geopolitical energy shock are all converging at the same point in time. Each one alone would be manageable. Together, they form the conditions for a market event that does not have a clean historical parallel. And the most dangerous thing you can do right now is assume that the playbook from past recoveries will work the same way this time. Iran is now charging yuan to let oil tankers through the Strait of Hormuz, and the dollar just lost something it can never get back. 72%. That was the dollar's share of global foreign exchange reserves in 2001. The entire planet held dollars because the entire planet needed dollars. Every barrel of oil traded on Earth was priced in US dollars. Every commodity, every international loan, every central bank reserve account was anchored to the greenback. That dominance was not a nice to have. It was the foundation of American economic power. It meant the United States could borrow at lower rates than any other country, run deficits that would bankrupt anyone else, and print money without immediately destroying its value because the whole world needed what we printed. That number is now 56.9% and falling. The IMF's own data shows the dollar's reserve share has dropped below 57% for the first time since 1995, and the war with Iran just accelerated that decline in a way that may not be reversible. Here is what is happening right now that almost nobody is talking about. Iran has begun charging yuan-denominated transit tolls for oil tankers passing through the Strait of Hormuz. A senior Iranian official told CNN that Tehran is considering formalizing this arrangement, allowing limited tanker passage only when cargo is settled in Chinese currency rather than dollars. That means the choke point through which 20% of the world's oil flows is now being used as a toll booth for de-dollarization, and the infrastructure to support it already exists. China's cross-border interbank payment system, CIPS, processed approximately 175 trillion yuan, roughly $24.5 trillion in 2024 alone, a 43% increase year over year. The system now connects 194 direct participants and 1,597 indirect participants across 117 countries. The plumbing for a yuan-denominated energy corridor was built quietly over years. The Iran war activated it. Deutsche Bank analysts noted that the conflict could be remembered as a key catalyst for what they are calling the petro-yuan. Saudi Arabia chose not to formally renew the 50-year petrodollar agreement in June 2024, the arrangement under which Gulf producers priced oil exclusively in dollars and recycled surpluses into U.S. treasuries. Central banks worldwide purchased over 1,100 tons of gold in 2025, more than double the annual average from the prior decade. And BRICS nations now hold 17.4% of global gold reserves, up from 11.2% in 2019. Gold's share of global reserves has risen from 13% in 2017 to approximately 30% in 2025. Central banks are not buying gold because they think it is shiny. They are buying gold because they no longer trust the dollar to hold its value, and they no longer trust Washington not to weaponize it against them. The freezing of $300 billion in Russian central bank reserves in 2022 was the moment that changed the calculus for every reserve manager on the planet. And the U.S. Treasury's own admission that sanctions against Iran were designed to engineer a dollar shortage, confirmed by Treasury Secretary Scott Bessent in January 2026, told every non-aligned government exactly what they needed to hear. Dollar holdings are not just a financial position. They are a geopolitical vulnerability that can be weaponized at any time. J.P. Morgan's research estimates that each 1 percentage point decline in foreign holdings relative to GDP, roughly $300 billion in treasuries, would result in yields rising by more than 33 basis points. That means if de-dollarization continues at its current pace, the cost of borrowing for the U.S. government goes up, the cost of your mortgage goes up, the cost of every loan in America goes up, and the national debt becomes even harder to service. The dollar is not going to collapse tomorrow. But the 15-point decline from 72% to 57% over 24 years is not a blip, it is a trend. And the Iran war just gave the rest of the world both the motivation and the operational infrastructure to accelerate it. Number 2. 722 banks are sitting on unrealized losses that exceed 50% of their capital, and the Fed just quietly injected $18.50 billion to keep them alive. Go back and read that headline again because I need you to understand what it means. 722 American banks are currently holding investment losses on their books that exceed half of their total capital reserves. These are not hypothetical losses. These are real mark-to-market losses on bonds that the banks purchased when interest rates were near zero and that have since plummeted in value because rates surged. The banks have not sold these bonds, so the losses are classified as unrealized. But unrealized does not mean imaginary. It means the losses are real, but the banks have not yet been forced to recognize them. And the only reason they have not been forced to recognize them is that they have not yet needed to sell. The moment a bank is forced to sell those bonds to meet withdrawal demands or cover obligations, the unrealized loss becomes a realized loss. And that is exactly what happened to Silicon Valley Bank in March 2023. SVB had $21 billion in unrealized losses on its bond portfolio. When depositors started pulling money, the bank was forced to sell those bonds at a loss to raise cash. The loss triggered panic. The panic triggered a bank run. The bank collapsed in 48 hours, and the FDIC had to step in. Now 722 banks are sitting in a similar position with losses exceeding 50% of their capital. The Federal Reserve just injected $18.5 billion into U.S. banks through overnight repurchase agreements, which are short-term emergency loans where the Fed buys securities from banks and agrees to sell them back the next day in order to inject cash and ease liquidity stress. That is the fourth largest liquidity injection since the pandemic. It is larger than the injections during the dot-com peak, and it happened quietly, with almost no mainstream media coverage. Now layer the Iran war on top of this. Oil above $110 a barrel is driving inflation expectations higher. Higher inflation expectations push bond yields up. When bond yields go up, the value of existing bonds goes down, which means the unrealized losses on those bank balance sheets are getting worse, not better. Every day that oil stays elevated is a day that the bonds sitting on those 722 banks' books lose more value. And at the same time, the private credit crisis we talked about in number 10 is creating additional stress because many of these banks have lending exposure to the same private credit funds that are now gating redemptions and seeing record defaults. J.P. Morgan has already restricted its lending to private debt funds. If other banks follow, it creates a cascading liquidity problem where the shadow banking system and the traditional banking system start pulling each other down simultaneously. Jamie Dimon warned about cockroaches in private credit back in September. He said when cockroaches surface, more cockroaches are usually lurking nearby. And now we are watching them surface one after another. Blackstone gating, BlackRock gating, Blue Owl gating, Morgan Stanley gating, Cliffwater gating, and 722 traditional banks sitting on unrealized losses that exceed half their capital while the Fed injects billions through the back door to keep the lights on. This is not 2008. The housing market is not about to implode in the same way. But the mechanics of what is happening in the banking system right now, illiquid assets losing value while the entities holding them try to avoid forced selling, that is the same fundamental dynamic that precedes every financial crisis in modern history. The question is not whether this gets worse. The question is whether it gets worse slowly enough for the system to absorb it, or whether one more shock, one more fund gating, one more bank forced to sell, creates the cascade that turns unrealized losses into realized ones across the entire system at once. And with oil above $110, the war expanding, and inflation re-accelerating, the margin for that kind of shock is thinner than it has been at any point since March 2023. Number 1. Every single thing I just told you is happening at the same time, and that is the part nobody wants to say out loud. All right, here we are. Number 1. And I want you to take a breath before I say this, because if you have watched this entire video, you have absorbed a staggering amount of information, and I need you to see what it looks like when you step back and view it all at once. Because here is the thing that nobody on television, nobody in government, nobody on Wall Street, and almost nobody on the internet is willing to say clearly. All of this is happening at the same time. Not sequentially, not one crisis followed by another with breathing room in between, all of it, simultaneously. Right now, the largest oil supply disruption in the history of the global energy market is colliding with a $3 trillion shadow banking system that is locking investors out of their own money. A stagflationary environment that Bank of America is no longer predicting but describing as current reality is colliding with an AI revolution that eliminated 1.17 million jobs last year and is accelerating. Bankruptcy filings are surging 14%, while 119,000 properties entered foreclosure in a single quarter. 5 waves of price increases are rolling through the economy on staggered timelines, and most Americans will not connect them until the damage is done. Michael Burry is warning that the market is a coiled spring, while the man who predicted the 2008 crash and was right says this time will be worse. The dollar's reserve share has dropped to its lowest level since 1995, while Iran is literally charging yuan tolls on the Strait of Hormuz, and central banks are buying gold at triple the historical rate. And 722 American banks are sitting on unrealized losses exceeding half their capital, while the Fed quietly injects billions through overnight repos to prevent a liquidity crisis. Each one of these is serious on its own. But what makes 2026 different from 2008 or 2020 or any previous crisis is that there is no single cause, and therefore there is no single solution. In 2008, the cause was subprime mortgages. Isolate the toxic assets, backstop the banks, flood the system with liquidity. Problem identified, solution deployed. In 2020, the cause was a virus. Shut down, stimulate, reopen. Problem identified, solution deployed. In 2026, the problems are structural, systemic, and mutually reinforcing. The war drives oil up. Oil drives inflation up. Inflation prevents the Fed from cutting. The Fed holding rates crushes housing, small business, and anyone carrying debt. The AI disruption is eliminating jobs at the exact moment the economy needs consumer spending to stay intact. The private credit system is freezing at the exact moment companies need access to capital. The banking system is weakened at the exact moment it needs to absorb shocks. And the dollar is losing credibility at the exact moment the government needs to borrow $1.9 trillion to fund the deficit plus $1 billion a day for the war. Every crisis on this list makes every other crisis on this list worse. That is the definition of systemic risk. And the people who are supposed to be managing it are telling you that gas prices going up a little bit is the last of their concerns. So let me tell you what I want you to do. Because unlike every one of those people, I am not going to tell you everything is fine and leave you hanging. First, do not panic. Sell your investments. The historical data is overwhelmingly clear. People who sell in fear lock in their losses. People who hold through capture the recovery. Your investing time horizon is decades. Act like it. Second, build your emergency fund to at least 90 days of expenses in a high-yield savings account paying 4% or higher. That cash buffer is not just financial protection. It is psychological protection against making desperate decisions when the next wave hits. Third, audit your spending right now before waves 3, 4, and 5 arrive. Cut the discretionary costs today so you are not scrambling reactively when grocery prices spike in September. Fourth, attack high-interest debt immediately. The Fed is not cutting rates. Your credit card at 23% is more expensive to carry every single day that passes. Pay it down now. Fifth, map your personal exposure to energy prices, to interest rates, to job market disruption. Know where your vulnerabilities are so you can address them before they become emergencies. And sixth, share this video. Not for me, for the people in your life who have no idea what is coming, who are still anchored to the gas station sign, thinking this is a temporary inconvenience, who do not know that their retirement fund might be partially trapped in a gated private credit vehicle, who do not know that the job they think is safe might not exist in 18 months. They need this information, and they need it before the window closes. Because the window is closing, you are watching this right now, which means you are ahead of most people. Do not waste that advantage. Take the steps, make the moves, and then stop doom scrolling the news and start living your life. You have done the work. You have the information. You will navigate this. But only if you act on what you now know, instead of waiting for someone in Washington to tell you the truth, because they are not going